Okay, we said if the company operates in Nigeria habitually through an agent, the company's profit will be subject to tax in Nigeria. We said if the company displays goods and merchandise upon which income is made, then such display of goods will be subject to tax in Nigeria. And I gave you an instance last week where I said most of the company that comes to trade fair, they are not Nigerian company. Who is that? Stop. Okay. So, oh yeah, stop writing on our board. And stop presenting. Okay, thank you. Okay. Okay. As I was saying, I said these companies, they are not Nigerian company, but unfortunately, these companies operate indirectly in Nigeria by displaying their goods or merchandise. And at the end of the day, these companies make profits or they make income in Nigeria. As a result of that, that means they are made income in Nigeria, and that income, even though they are not a resident company in Nigeria, will be subject to tax in Nigeria. We also said where the company operates a single contract of survey, delivery, installation, or in general, say turnkey projects, such will constitute income and will be subjected to tax. I'll give you an instance. You bought a machine abroad, but you are not able to install it yourself. You now call the company to come and install it. You know they will charge you. So that cost to you is a cost, but to them is an income that is made in Nigeria. Even though they are not a Nigerian company, they are made income. Again, we could also liken this into construction. Okay, now Julius Berger is not a Nigerian company, but they construct road everywhere in Nigeria. So any income made from that will be subject to tax in Nigeria. So that is that. So this activity, which is a turnkey project, is a single project. It's not that they are operating here forever. They are just here to do that project. After they are done with that, they bail out to their country. So we say any income attributable to that will be subject to tax in Nigeria. We also talked about where a company has a significant presence in Nigeria. Significant. significant presence in Nigeria, significant economic presence in Nigeria. What does that mean? That means when we say a company has significant presence in Nigeria, the company had generated a turnover in Nigerian currency or other currency that is not less than 25 million naira. It is not less than 25 million naira. And at the same time, these companies is operating in Nigeria online. Operating in Nigeria online. That is, what we are trying to say here is that the company is not a Nigerian company, but they have digital presence in Nigeria. It's not a Nigerian company, but they have what? A digital presence in Nigeria. For example, Facebook is not a Nigerian company, but Facebook has a digital presence in Nigeria. So, as I was saying, this company has digital presence in Nigeria. And the fact that they have digital presence in Nigeria, that means any income that this company generates that is above 25 million means that this company is significantly present in Nigeria. And therefore, they will be subject to tax appropriately. Okay? They will be subject to tax appropriately. And that is what we are saying. Now, having understood that, we also said where a company renders, a foreign company now renders a professional management, technical, and consultancy service to a resident in Nigeria, such a transaction shall be subjected to withholding tax, which shall be the final tax liability on the income. Do you get? So if they render this service to you, such a company, even though they are not Nigerian company, they have constituted Nigerian company. You know, they have dealt with Nigeria. Sorry, I'm trying to clear someone at the gates, my estate gates. All right. So as I was saying, if this kind of person or this company renders this kind of service to your company or to a Nigerian company, we say, even though they are not Nigerian company, but the service that they have rendered will make us subject them to withholding tax in Nigeria. So they will be subject to withholding tax in Nigeria. So that means if the examiner asks you to write something on how can the income of a non-resident company be subject to tax in Nigeria? You know what to do. In my last class with you, I remember we talked about relationship between the parent company and branch. Talked about relationship between, so this branch, it could be local branch or foreign branch. Okay. We also talked about relationship between parent company and subsidiary. It could be local subsidiary or foreign subsidiary. So go and watch the video I did last class to brace yourself on that. Okay, we'll move on to the next one. The next one now is filing of returns. Olamide, you deliberately held my mic or my internet. Mr. Man, you held my internet deliberately.
I'm not aware I did that now.
So that I will not ask a question. Now lie you lie. I was
so
asking you what the resident company is.
Okay, a resident company is a company that is registered in Nigeria.
Thank you. Any contrary opinion? Emmanuel?
No, sir.
No contrary opinion, sir.
Why don't you have contrary opinion?
And that's because the company registered in Nigeria is simply registered with the Corporate Affairs Commission. So I don't think. For me, that is how it is.
Okay. Who else? Who else? I can't hear the lady's voice. Oluwanifemi, challenge them. These people are just telling me what they like. Challenge them. Oluwanifemi mic is still on.
Sorry, sir. I was attending to my dad.
Okay, challenge them. Tell Dad that you're in class.
I told him already.
Oh yeah, challenge them. They have told us something that is not correct.
That's what I know.
Okay, if a resident company is a company incorporated and registered in Nigeria, okay, so you do not have any issue. And again, their income will be subjected to tax in Nigeria because they are resident company in Nigeria. Okay, give me 1 minute. So, sorry about that, sir. So, a Nigerian company is a company that is registered in Nigeria. And for the purpose of filing returns, such a company must also file their returns in Nigeria. Okay, so when I say filing of returns, mention your mic. Mention your mic. Yesterday. Mention your mic. Olawale. Okay. Thank you for going out of the meeting. So, as I was saying, I said filing of returns. You see the board cleared. Yes, the first board cleared off. I don't know where you can see that. Let me see. Oh, so the first one I did, I can't find it again. That one has cleared off. You will watch it on the video. So when you're filing your return, there are some content of your tax return that you need. At every point in time, those contents are very important. So the first one that you must file as a company is your annual financial statement. Annual financial statement. And you know that your annual financial statement comprise of a lot of things. So if you have the strength, you can put it. Okay. Number 2 is your computation. Computation of your capital allowance and you include your assets and the next evidence of tax paid. Because you know that we now operate on self-assessment. You first assess yourself before the tax authority looks at your statement. If whatever I give to them is fine, no additional assessment. But if whatever I give to them is not okay, they will ask for additional assessments. The next one, a duly completed self-assessment form. And this must be attested with by the responsible person. When I say responsible person here now, it could be the CFO, the finance manager, or a director. It could also be the company secretary. Okay, a duly completed self-assessment form, and this must be attested to by the responsible person stating that all the information provided is true and correct. Correct statement is true and correct statement of the profits computed by the company. You know, it is on this, it's on the product that you compose your tax paid, right? So you must show them that. The next one, before the tax paid, you talk about your computation of adjusted profits, loss relief, and capital allowance slash total profits. So these are the content of the returns that the tax authority wants to see. Now, it is very important that you as an accountant, you abide by this, because failure to abide will lead to penalty. Now, that content is for resident company. What about non-resident company? Because non-resident company are not obliged to pay tax in Nigeria, except if those conditions that we spoke about the other time, except if they have carried out business and a fixed-based operation in Nigeria, actually operate in Nigeria, or maintain a stock of goods or merchandise in Nigeria, or they significantly operate in Nigeria, or they have turnkey projects in Nigeria, then all this will be required of them. Okay, number one, full audited financial statements. Full audited financial statements and audited statements of Nigerian operation. Now, what we are trying to say here is that, firstly, you will give us the group audited financial statement and the audited financial statement of Nigerian operation. We need to see it. It's very important. Number next. Tax computation schedule based on the profit attributable to Nigerian operation. Next one, a true and correct statement in writing containing the amount of profits from each and every source in Nigeria. We are concerned more about Nigeria. Okay. And the next one, a duly completed company's income tax assessment. So Those are the contents or returns. Any question so far? Any question so far? Okay. If there is no question, we go to time limit for final returns. What are the time limits for final returns? So we're going to be looking at it from two perspectives. The first one is existing companies. For an existing companies, such a company must file return, filing of returns must not be later than 6 months after the accounting year end. What? Later than 6 months after the filing of accounting year end. Okay? So after the accounting year, so imagine the accounting year of the company is 31st January. The guy must file max 31st of July. If the accounting year of the company is 30th June, the guy must file 31st December. If it is 31st December annually, the guy must file in June 30th. And that is why you see many tax consultants run your tax data during filing. And at that time, FIRS what I used to crash is because of all this rush. So you must file returns within 6 months after the accounting year end. Okay? The next one. For a new companies, the new companies must file their return within 18 months from the date of incorporation or within 6 months after the accounting year end, whichever comes first. Okay, so they must file their returns within 18 months from the date of incorporation or 6 months after the accounting year end, whichever comes first. Okay, so that is that. Now, the next one is penalty for failure to file returns. Penalty for No, the penalty. Number one. Anybody that fails to file return, any company that fails to file returns will be liable to 25,000 in the first month of default and 5,000 for every subsequent month in which the failure continues. So if a taxpayer did not file its returns as and when due, that is within 6 months after the accounting year end, then the company will be liable to a penalty of 25,000 in the first month of default and 5,000 for every subsequent month in which the failure continues. Number 3, if the offense has been committed where the offense has been committed with the consent or connivance of or neglect by any director, manager, secretary, or the responsible person to carry out the task. Or such a person upon conviction shall be liable to 100K in the first 100K or a prison term a prison term 100K or a prison term of 2 years or a prison or an imprisonment, especially that spell imprisonment.
IMPRISON.
Imprisonment. Thank you.
On top of my salary, now she put
2 years, only develop 2 years.
You're hearing me? Sorry, I'm not even on mute.
Or both. So if a person that is supposed to do the job of filing returns fails to do so, the person will be liable to a penalty of 100K or an imprisonment term of 2 years or both 100K and the 100K. So don't mess up your filing. Now, notwithstanding what we have said, notwithstanding what we have said, there could be a reason why company will not be able to meet up with the filing of returns. That could be reasons. But the only reason the act gave is the taxpayer, for him to be exempted from this penalty, must have applied for extension of period if the deadline is impossible to meet. So, and that extension must be before the deadline. So what we are saying here is that you can actually extend your filing of returns, but you cannot do that after your after your period of filing. You must have done it before the deadline. So if deadline is 31st of July, and you know that you'll not be able to meet up with 31st of July, you must have requested for extension from the tax authority. It is not when the thing has now expired. That's when you now be saying a due extension. You will be slapped penalty. Or an act of God. So in the act stated that the company shows a reasonable cause for its inability to comply. Now, this inability stemmed through, number one, maybe the death of the chairman of the company, natural disaster. You remember during COVID, a lot of people could not file. Flooding and maybe fire, all those things are natural disaster. Now, during those periods, companies could not file their returns. It is the government that even extended for people. Government extended for people because they could not file their returns because of the what was it called? COVID. They couldn't file their returns because of COVID. So government extended the filing of returns. So without all this, you will not be able to extend your listing. Do you get? So having said that, we move on to the next one. The next one is the benefits for filing a return early. Benefits of filing return early. The Act specifically divided this into two. That if you are a large company, and for medium company. Now, the ask is, if a taxpayer is able to pay his tax liability and file returns within 90 days, as against the 180 days, which is 6 months. If he is able to do it within 3 months, there shall be rebates as follows. The first one, if it's a large company, 1% of the tax due will be granted as relief. If it's medium-sized company, 2% of the tax due. Who else is not seeing my board?
It's me, oh.
Who else? Who else? Can you guys see what I'm writing on the board?
Yes, I can see it.
Okay. That person, go out of the meeting and come back. It's your network. So what we are saying here is that if the company is a large company, the tax due of 1%, if, for example, the person is supposed to pay 95 million, 1% of 95 million, I think, is 95,000. So this 95,000 will be, am I correct? Is it 95,000? Really? Gilly. Oh God. That person is around, a bush person. Mute your mic. Yetunde, you have been distracting our class. What is the issue? Okay.
Network issue, sorry.
Stop unmuting your mic. It's not right. If you want to talk, you are free to.
Hello, sir. Good morning, sir. Sorry, I missed your call. Sorry.
You can see some of you do not have, you don't understand the whole governing accounting profession. Number one is this. Mute your mic. It's still not. Who is this other seconds? Okay. So one of the rules that guides this profession is discipline. You have to be disciplined. When they say do this, you do it. That is why you are an accountant. Follow the rules strictly. It will help you a lot in your career. Let's go ahead. So imagine the person is supposed to pay 95 million naira. And now say 1%. Is 1% of 95 million days or 950,000? I think it's
950,000.
So they will now give the relief of 950,000. Okay. Now this 950,000. So this year that you are paying your tax, you will pay everything. Do you understand me? You will pay everything. But what will now happen is that in the subsequent period, you will now have to relieve your tax from the subsequent period. Do you understand what I'm saying? So that means you will not be allowed to relieve the tax rebates now. You transfer it to subsequent period. So that means this year you will still pay this your 95 million as tax. But in let's say this is 2022. In 2023, if you are supposed to pay your tax, if you pay early also, let's assume you are supposed to pay 100 million. You pay early. That is, how much is that? 1 million. You see this 1 million, you will defer the utilization to the next year. You see this 950, you will bring it to this year. Balance. That is 9, I think 905 something.
No, 99,050,000 naira.
Okay. So this 99 million how do you write 99,000? 99 million. 05. So this is what you will pay this year. Do you understand? Because the act is that the tax liability that you're supposed to pay will be deferred into the next year and will be made available against future remittance. Okay, so your future remittance is you're supposed to pay 100 million, but you will now be paying 99 million. Why? Because you have a tax credit from the previous period that you're utilizing against this. So I was looking at it that does 1% isn't justifiable for me to pay my tax early, knowing fully well that if I put that money in treasury bill for that 6 months, for 6 months, I'll get like almost 22% divided by 2. Because that's half a year, I'll get 11%. So if I calculate 11% of 100 million, that is 11 million. If I go hurriedly and pay my tax, I'll only save 1 million. But if I wait till the deadline, wait till maybe on the 30th of June, which is the deadline, and I remit this my 100 million, I would have invested that 100 million and I would have gained 11 million as against this 1 million. And that is why this particular law is not effective. Because accountants knows that I can utilize my money in the money market to generate fund for me. So even before I pay tax, I have generated this fund. And knowing fully well that this tax on treasury bill is also exempted from tax. It's exempted. So I will not still pay tax on that profit. So it is better I invest that tax liability, I invest it, so that at the end of the day, I'll get more income. Do you get me? Am I making sense at all? Instead of rushing to pay within 3 months, and I would have lost about 10 million naira. So which one would you do? Would you rather pay on time within 3 months and lose 10 million, or you wait till the end of the term of your investment and cash out 11 million and you just get 11 million? Which one would you prefer?
I'll wait too.
I'll wait and cash out.
I'll wait and cash out. So this law does not even encourage the taxpayer in any form, because at the end of the day, I'm not making enough. Imagine they have said 10%. Do you know the number of people that will pay on time?
Or even 15 to 20%. It's still reasonable.
That is too much. Let's just say 10%. If you pay within 1 month, let's just say if you pay within 1 month, they give you 10%. Do you know the number of people that will pay? And you know, in your SFA, we talk about time value of money. Time value of money. So 1,000 today is not 1,000 tomorrow, because by tomorrow, this 1,000 would have been discounted by inflation, by everything that is happening in the country. So if they had done it that way, it would have been better for the tax authorities, because they will get more money. And if they need to invest it or do whatever they want to do with it, they will be able to do it with that money. Well, let's see if the new acts, the new one that they have done, would address all these salient mistake. So that is that. So, and I know in your mind you'll be asking me what is large company and what is small company, what is medium size company. We will get there. Just note all this.
So you didn't address the aspect of the small company. You only focus on large and medium companies.
Oh, for small companies are exempted from tax. Okay, because they are exempted from tax, there is no bonus. They are not paying tax.
So they're not filing annual returns too.
They are filing returns at their own terms. The act does not really have issues with them. Okay? In fact, I was telling someone before they change this act, I was saying it is even better to open a company than to be doing individual business. Because if you open a company, if you make turnover of 25 million, you will not be subject to tax. If you open a one-man business under payee, under personal income tax, you will be subject to tax at the end of the day, because their own tax is graduated. They will say first 300,000, next 300,000, next 500,000, next 500,000, next 1.6 million. You know, so at the end of the day, you would have made more than that. So you'll be paying tax on all this small income that you make. So that is why I've always advised that you should do company instead of individual. So that's that.
So please, I have a question before we go to person.
Go ahead.
Okay, so my question comes from the part of filing for a new company, and from what you had said, you said that the company would have to file within 18 months of incorporation or 6 months after the accounting year end. Now, for cases whereby a company is being registered and did not commence operation, are they still supposed to file within 18 months?
So you are, according to the law wants you to file even though you have not commenced operation. Okay? You file within 18 months from date of incorporation. There is no exemption to that. Okay, or 6 months after your accounting year end. So there is no exemption. So that the law is specific about that. Section 55 of CETA is specific about what I want to do when you just commence operation. Even though you have not commenced operation, even though you have not started, but you have been incorporated, then you must file a return within 18 months. So if your accounting year end is 30th November. Okay? And your date of incorporation, let's say, is 1/4/2000. Okay? So your accounting year end is 30th November. So we are saying you must file your returns within 18 months. If I count 18 months from these dates, will be how many months? Oh yeah. April, May, June, July, August, September, October, November, December. That is 9. 9 plus 9.
Next year, September 21.
Right? So, meanwhile, your accounting year end is this. 6 months after the accounting year end will be, how many months is that? That will be December, January, February, March, April, May. So, your accounting year end, 6 months after, will be 30th, 31st May 2021. Which one comes earlier? Is it the 18 months or the 6 months? The 6 months after comes earlier. So you must file returns on 31st of May 2021. Do you understand?
Yes, sir.
So our assumption here is that your accounting year end, and after you have incorporated, you choose accounting year, you have chosen this. So for this year, you have November 30, 2020. So counting it forward, you have that. So let's move on to the next one. Okay, the next subtopic is very important. Okay. Payment of tax liability. Now, for the purpose of this, now I want to urge you, for those of you that you don't like attending classes, I have said it, Samuel Yewo, you are new in my class.
Yes, sir. Good morning, sir.
Good morning. Welcome.
I just rest today, basically.
Okay. You're welcome.
Thank you so much, sir.
So in case you need to, in case you need any help, you can reach out to us. And the videos that we have done in the past is also available on the internet. Just go through them. Now, your exam question is patterned in this direction. Number one, companies income tax. Number two, examiner tests hydrocarbon. Number three, they test either capital gains tax, double taxation, international tax. Number four, The pattern number 4 to be tax planning, tax audits, merger and acquisition, so number 5, we will talk about contemporary issues in transition, 5 to 7, where they'll be talking about country by country reporting. We'll be talking about transfer pricing. We'll be talking about base erosion and profit shifting. So all those contemporary issues will be discussed there. Number 7 at times, we go to transition of mining industry. So you can see that it is very important that you focus on all these things that we are saying, because company income tax is number 1. Number 1 under exam condition is 30 marks. This is 20 marks question. This is 20 marks question. All these contemporary, they are 15 marks question. So, and you have to be systematical in answering questions on the examination of. Some of you just answer question anyhow. You have a question that is 20 marks, 30 marks, and what was it called? And 15 marks. Instead of you to be systematic and answer the question appropriately, some of you will leave the question that has 20 marks. You will now be struggling with the one that has 15 marks. It's not done. So the best bet, look at it when you give one question, look at the ones you can answer. Because you know from section 1 is not compulsory. Section 2, you have to answer 2 out of 3. Section 3, 2 out of 3. So look at them, prepare yourself very well. Don't just dabble into the question. Look at the question, look at the way you're going to answer them, then start. If you are comfortable with answering questions from the section C, which is the 15 marks, start from there. Do the 2 and move on. If you are comfortable with answering question number 1 first, start from there. Okay? And it's not necessary that your question follow, I must say, if you are answering question in question C now, if it is number 7, you know before number 5, do number 7 as your number 1, as in the first question you attempt. Because at the back of your question, examiner usually puts it there, that you put the order in which you have attempted the question. You write it down. So maybe question number 7 is the one you first attempted. You write question number 7, the way you have attempted it. So you have to be very, very careful and be sensitive about this exam. Again, I want to urge you. You can see that I'm coming to class early these days. It's because I know that we have a task ahead of us. For under this company income tax, we'll do at least 3 past questions. At least 3. So I want to always come to class early. Some of you did not come to class early today, and I gave you like 3 to 4 minutes. Next week, Sunday by the grace of God, my sister and my brother, now 8 o'clock. 8 o'clock I'll start my class. If I see one student in the class, you will join us there. Okay? So let's move. So I want to quickly focus on company income tax. After company income tax, I'm also doing hydrocarbon tax with you. Okay, so you can see that I have a lot to cover. Okay, and we have a pattern in which we teach all these topics. You can see the pattern. So that is it. So let's go. How do you compute your tax liability under company income tax? So what is very important is we are going to be looking at different ways in which tax liability are paid under company income tax. Ways tax liability are paid under company income tax. Number one, tax liability could be paid. I hope you guys are always jotting. Could be paid on dividend. Tax liability on tax liability on dividend. Tax liabilities will also be on turnover. Would also be on total profit. And the last one, minimum tax. So I'm taking them one after the other. Tax liability on dividend. Section 19. What does Section 19 of CETA say? Before the advent of financials, Section 19 of CETA says that companies will be liable to tax on their dividend where there is no total profit. There is total profit but it is less than the dividend declared. Let's go again. I said companies should be liable to tax on dividend. Companies should be liable to tax on dividend. Companies shall be liable on dividend where number one, where there is no total profit. Number two, there is total profit, but total profit is less than dividend declared. So we are saying the company will pay 30% of their dividend. So if the dividend declared is, for example, you declare a dividend of 100,000 and you made a profit of 60,000. The act says that the company will be subject to tax on 100,000. That would be 30,000. Do you understand? So the company will be paying a tax liability of 30,000 instead of which will be 18,000. Okay, so ordinarily, the company would have paid tax liability on this 18,000, but this 18,000 that was paid is not adequate. So the balance of 12,000 will be an additional liability to be paid. Do you understand? Now, this was the position before the Finance Act 2019. Are you following me, please?
Just trying to get a picture of it.
Let me explain. Section 19, subsection 1 of CETA says that company will be liable to dividend, will be liable to tax on their dividend, where number one, the dividend, the total profit is not available. That is, the company makes loss, so there is no total profit. Number two is as the company makes a total profit too, but the profit is less than dividend declared. Okay, so if that is the case, instead of subjecting the company to tax on their total profits, the company will be subject to tax on the dividend declared. Do you get? Do you get that now?
Yes, sir. Yes, sir.
Good. That was the position of Finance Act before 2019. That was the position of the company income tax before 2019 Finance Act. Excuse me, guys. With the advent of Finance Act, the Finance Act now says, Section 19, subsection 2 of Finance Act now says, dividend shall be exempted from tax where it is paid from one, where it is paid from, retained earnings. Where it is paid from one, retained earnings. Two, it is paid from frank investments income. Three, if it is paid from profits already exempted from tax by the provision of CGT, EPT, and pioneer legislation. Number next. Where is the distribution? Where the dividend is made from distribution made by real estate investment company to its shareholders. To shareholders from rental income provided at least 75% of this income is redistributed. Okay, I'll leave that out. That's another. Let's do that. So if it is the dividend that the company received from real estate investment company, from rent, such will be exempted. So we can say that dividend taxation is very important, because when you look at this, you said dividends shall be exempted from tax. Exempted from tax where it is paid from the following. Number one, if it is paid from retained earnings, it will be exempted from tax. Turn off that light. If it is from frank investment income, it will be exempted. If it is from profit already exempted from tax, it will be exempted. If it is distribution from real estate investment company, it will be exempted. So let's look at an illustration. Let us assume we have an extract from the financial statement of ABC Limited. Okay. For 2021. We have loss for the year. We have retained earnings. Go forward. Dividend declared. Paid in 2022. $1.5. So determine whether ABC Limited is liable tax for 2022 year of this. Okay. Can you see the question, everybody?
Yes, sir.
Good. Okay. According to the principle, section 1 of section 19, section 19, section 1 of CETA says that where the company makes loss, the company will be liable to tax on what? On dividend. Or where the dividend is more than the profits, the company will be liable to tax on dividend. However, subsection 2 now supersedes subsection 1, where we say that if the company's revenue, if the company has a retained earnings, or if the dividend is paid from retained earnings, then the company will not be subject to tax on their dividend. Now, when you look at this, a company that made loss of 1.5 million, will the company be able to declare dividend? Chineye, this company made loss. Will they be able to declare dividend?
They can.
They can.
Yes.
How?
Yeah, but the dividend will not be paid from the current company's profit. Losses, rather. It will only be paid from retained earnings.
That means invariably this company cannot pay dividend because they made loss. Isn't it? Is it not?
Yes, sir.
They cannot pay. Nifemi, this company cannot pay because they made loss. Abi?
I thought that
I
if
guess you
they
can say so, but I assume that they can pay from retained earnings.
Let's assume we don't
Do
have retained
companies
earnings.
really say,
Let's assume
okay,
we don't have
if
retained earnings in this question. Let's just say
okay,
even loss and dividend. Will this company be able to
okay,
pay with this loss?
No, sir.
no, they will not be able to pay.
They will not be able to pay. Why?
Yes,
Because they did not make profits. But however,
yes, and they don't have retained earnings.
this company went ahead to pay 1.5 million when they made a loss of 1.5 million. That means they must have gotten the money from somewhere where retained.
So,
Therefore, because the dividend came from retained earnings, the dividend shall be exempted. The company, I'm answering the question now, the company shall not be assessed to tax for 2022 year of assessment as the dividend was paid from where retained earnings, which is exempted from tax. Abi, if you don't understand this, let me know now before we move on.
Hello, sir.
Yes, Samuel.
Okay, so briefly, I just want to you to reiterate the part where the retained earnings is it in jackets? Is it like a negative retained earnings? Go forward.
No. I was one
Okay,
that
it's a positive. Okay.
did that. Just
So
to
okay, so my question now is that a cash outflow of 1.5 was paid. So
yes.
where exactly is the position of the excess coming from if retained earnings as low as 1 million, and then
No,
the
this is
outflows?
this is 11 million.
Okay, 11. Oh, sorry. Okay. Oh, it's very clear now. Yeah.
Another person. Okay. Let's go at scenario 2. Scenario 2. Extracts from the FS of MQ for 2021 shows the following. Who can explain the scenario here for me? Who is explaining the scenario here?
There's profit of 11 million, but the dividend that was declared, 15 million, is greater than the profit for the year. So the tax will be on the dividend declared.
Who else?
Okay, so I will say the profit for the year is 11 million and the dividend declared is 50 million. So the tax, it will be subject to tax based on 11 million, because it's very obvious that they are going to pay the difference of 4 million from retained earning brought forward.
Who else?
Oshina.
Yeah.
Yeah.
Yes, sir. I believe the tax will be paid on the profit for the year, sir.
Yeah. Both you and Chinaya got it right, but Chinaya's own was more explicit. Okay? The company will be zero tax on the profit for the year. However, the dividend declared must have been declared from this dividend was declared from 11 million and 4 million. This 11 million is from the profits subject to tax. This 4 million, zero tax, because this 4 million was paid from retained earnings. Abby, do you understand me?
No, yes, sir.
Yes, I do.
Let's go again.
Yes, sir.
This 15 million has two components. The first component was 11 million profit for the year. In your SFM dividend policy, you remember we usually say if you make profits, your profits is equal to dividend and retained earnings. If you do not share the profits as dividend, what do? You retain it. And that's what we talk about dividend ratio, retention ratio, all those things in SFM. So when you look at this guy made 10 million, 11 million rather, but went ahead and declared 15 million dividend. Where would you see the balance? It is certain that the balance will be seen from the retained earnings, right? And we have said when you pay dividend out of retained earnings, it is exempted from tax, right? So this guy paid 4 million from retained earnings, is exempted from tax. 11 million was paid from the profit. That 11 million is where the tax. at the appropriate rate. So that is that. Any other question?
So I wanted to, is it possible for a company to claim to pay dividend from retained earnings despite having like more profit? For instance, maybe in this question now, let's
Let's
say
go to the next question. Let's go to the next question. You will see it.
Okay, sir. Sorry, I just want to draw your attention to something. Now, so dividend that is declared, is it a proposed dividend, and does it justify that every amount in the total profit can actually go for dividend? Is it based on policy approach, or is that is statutory that
There's
the
no
company can,
statutory. It's not statutory. Company can declare all the dividend, all the profits that they make
for
in a year.
dividend?
Yes, all the profit they make in a year, they can spend everything and distribute to their shareholder. There is no statutory provision for that. Okay, look at this scenario. What would you say? Someone was asking question the other time. So what is this? What is the solution? Is this company going to be subject to tax?
yes.
On what basis? Is this 42 million going to be exempted from tax?
No, sir,
Why?
because they could have gotten it from profit.
Yes. So this entire profit will be subject to tax, and there is no exemption. This dividend is not going to be exempted from profits, from tax, because it was paid from profit, not from retained earnings.
But sir, would the basis be on dividend or on the profit?
Yes. So because this tax, this dividend is already part of this profits, you get. So they made 52 million and they paid 42 million. Do you understand me? So this 42 million is not exempted from tax because we are taxing this entire 52 million, which is where the 42 million came from. Do you understand?
Yes, sir.
So that is that scenario. So dividend will not be paid on tax where it is from retained and will not be paid, tax will not be paid on dividend where the dividend is from retained earnings. We also said tax will not be paid on dividend where the dividend is frank investment income. And that is why whenever you have frank investment, whenever you have dividend in your financial statement, what do we usually do? We remove it. Dividend is not taxable. Okay. We move on to the next one, which is going to be the last topic for today. And we'll see again in the next class. We'll talk about the tax liability on turnover. Turnover, we call it turnover assessments. This is section 30 of CIPA. What does this say? What does this say? How will we have to tax on the dividend on the turnover where one there is no accessible profit 2, there is accessible profit, but it is less than expected from the company within the same industry. So what we are trying to say is that there is no accessible profit. If there is no accessible profit and the company has a turnover, the company will assess the tax on turnover. Number 2, there is accessible profit, but the accessible profit is less than expected from the company within the same industry. Equity professional. Equity professional is in the same industry with top talented talents. It's in the same industry with passport. So if we are saying our assumed profit is 5 million, our turnover is our assumed 5 million or 50 million. This guy is saying his own is 10 million, and this guy is saying his own is 75 million as assumed profits. Then this assumed profit becomes a doubt. So the government or tax authority will now request for the turnover because assumed profit seems unreasonable based on the fact that you work in this industry. So what does the act say? The act, the company shall be subjected to tax based on the fair proportion of the turnover. This is like an anti-tax awareness measure. Okay, so the company will now be subject to tax on its turnover. Okay, based on the turnover. And the fair proportion is determined by the tax authority. In the recent time, we have seen 20% of the turnover. From 10%. So based on the discipline of the tax authority, they will bring the percentage. So that is that. So we are saying turnover assessment will occur in a situation whereby there is not zero profit. Number 2, there is zero profit. As zero profit is less than expected, then the tax authority has right to subject the taxpayer to tax based on the fair proportion of the turnover. Okay, so fair proportion of the turnover. This fair proportion, we do not have a standard for it. So it is based on the best of judgments of the tax authority. Do you have any question? Do you have any question? So in my next class, we are going to be looking at minimum tax. And total profits. In my next class, we will solve one exam question. By next 2 weeks, we are solving 2 exams question, minimum of 2. So that would mean we are done company income tax. In 3 weeks' time, we are starting hydrocarbon tax, and I am expected to use 3 weeks on that topic. Okay, good day to you. See you by the grace of God next week. Love you all, and God bless you for coming.